Hello guys and welcome back to That Investing channel. My name's Jordan and today I wanted to show you guys how I'm building a dividend growth portfolio and how you can too. I'll be showing you my dividend growth stocks on Trading 212, why I chose them and what you should be looking out for to start building your very own portfolio. Please remember guys, I'm not a financial advisor, I'm just a normal guy and this is meant for only educational purposes. As always, if you guys like this video and want to see more just like it, then feel free to hit that like button and don't forget to subscribe for future content each and every week. So why do we love dividend investing? The idea of growing a passive income stream that builds over the years is something that is attractive to many people. I've been inspired by stories just like Warren Buffett buying Coke at a forward PE of 30 all the way back in 1988. People probably thought it wasn't the best idea at the time, but he saw its potential and now he has nearly a 50% yield on cost every year just for owning the stock. No wonder he doesn't want to sell it. So how do we do this with our own money? Well, firstly, we have to see the potential in the stock, not just the current yield. Take my dividend growth portfolio as an example. My dividend yield is a tiny 1.67%. So many people may think, well, that's just ridiculous. But the dividend growth rate average among my stocks is sitting at a very comfortable 11.11%. So all going well, that yield will grow by this much each and every year. That's whilst my stocks appreciate over time and also get capital gains, so I'm benefiting in both ways if I've done my homework right. My stocks like United Health Group, Texas Roadhouse, Moody's, mostly all have growing dividends. Let's give a closer up example of one of my stocks. Visa, the credit and debit card transaction company I'm sure everyone knows of. Over the past 5 years, its stock price has gone up by 80%, right in line with the S&P 500. Now here's where things get interesting. Visa has been raising its dividend for the past 16 years in a row, averaging 18% over the past 10 years. So each and every year you collect dividends and they keep going up along with the share price. So our capital is increasing each and every year. We are getting more just to hold the stock. This leaves us with a dividend yield on high growth stock just like Visa of 3.44% in just 10 years. And if we held 15 years, an amazing 15.58%. So that's great, but how do we know if a stock is going to be great just like Visa? When I'm buying a stock, I look into the business model of a company and see if they have a competitive advantage and lots of areas to grow, which Visa does. Then I consider the financials. Are they growing their revenue consistently? How about their bottom line income? Is that doing the same? Both yeses for Visa. Next up, I check their free cash flow. Is it growing fast? And do they have a good cash position in relation to their amount of debt? Both, again, a check for Visa as well. So it's looking pretty good, but we haven't looked at the dividend safety or growth yet. I like to use Simply Safe dividends to get a feel for the safety and scalability of those dividends. Have they cut dividends before, or do they have a history of raising them? Do they have a low payout ratio so we can see it's safe and we'll get in big double figure increases each and every year? That's another tick for Visa. So we can see it fits with my rough checklist. But please bear in mind this list could go on forever and there is more to it than simply these bare bones. This is a good start point. Now that we've established what to look for in a dividend growth stock, how do we build a portfolio? Do we worry about diversification in sectors? I may be controversial and say that I don't worry about that, as I follow the premise that the idea of diversifying is when you don't know your investments, and I like to think I do, so I double down on them. But the real answer is do what you're comfortable with. There is probably 100 of investors that focus on this concept of diversification and would say I am wrong. To make this portfolio safer, I just simply don't do it. You can decide for yourself whether you want to. However, there is a good point to that. I won't buy a stock over its intrinsic value just because it's that stock. So as stocks have gone up, I've had to look for other interests and other stocks that may fit my current profile and threshold. For example, Visa is slightly above or on its intrinsic value right now. But United Health Group and Vici, two other holdings that I hold in my portfolio, are well below them. So maybe I'll focus on them when I go to add to this account. So some last minute pointers for building that dividend growth portfolio that you really want. Please do your own research. Don't rely on YouTubers, don't rely on random people's advice. Look into a company, its financials, its earning reports. Get to know it and become familiar with it. Do not buy them at inflated price tags just because they fit the checklist you make, but wait until they fit your own risk assessment and valuations that you've laid out and you're comfortable with your buying price, even if it goes down and you see that fateful red. Finally, don't focus on the yield. Consider the scalability of the investment and whether it's a Visa of the future. So that's about it, guys. Thank you very much for watching. I hope you got something out of the content. Feel free to subscribe and follow along as I build my dividend growth portfolio and see how I'm doing and maybe learn from my mistakes. I'll leave a link in the description concerning my most recent update on my growth portfolio and see how it's doing this year. But thanks for watching. It means a lot, and I'll catch you guys in the next one. Best of luck with your investing.